Not every structure break you see in the market is actually going to turn into a full reversal. A lot of the time, it's just what we call a liquidity sweep. Basically, the market shows you a break in structure, but instead of continuing in that direction, it snaps back and moves the opposite way. In this video, I'm going to walk you through the difference between a real structure shift and a liquidity sweep. I'll also show you a few market scenarios where a structure break is less likely to lead to a real reversal and more likely to flip and turn into a sweep. Alright, let's jump into it. To really understand structure shifts, you first have to get how market structure actually works. In an uptrend, we get those impulsive continuation moves. Basically, the strong pushes upward that break structure and create new highs. Even inside those, you can think of the small pullbacks turning into impulses as tiny little structure shifts happening over and over. But a real structure shift is different. That's when we actually see the market flip direction. For example, in an uptrend we're making higher highs and higher lows, until suddenly we break and create a lower low. That's the moment where, from a structure point of view, we'd expect a retracement, a lower high, and then a continuation downward. That kind of shift usually kicks off a brand new downtrend. Same idea in a downtrend. Once the market creates a higher high, we expect a higher low and then a move up, starting a new uptrend. But here's the thing. Not every structure shift you see is real. Not every reversal-looking move actually turns into a proper trend change. A lot of the time, the market just sweeps a low, fakes the reversal, and then snaps right back into the original trend. It looks like the trend is flipping, but it's actually just grabbing liquidity before continuing the way it was already going. And this is where tons of traders get trapped. They see the lower low in an uptrend, they think, okay, reversal time. So they start selling, and then the market turns right back up and destroys their position because it wasn't a real shift, it was just a sweep. So the big question is, how do we tell when something is a sweep and when it's a real reversal? How do we know which structure shifts actually matter and which ones are just fakeouts? And that's exactly what this video is about. Here we're looking at the pound chart on the daily time frame, and we want to break down the market structure to forecast the next move. The first thing we notice is that price has been printing higher highs and higher lows, so naturally, we're in an uptrend. But then something interesting happens. Price begins engineering equal lows, sweeps them, sells off, shifts structure to the downside, forms another set of engineered equal lows, and then pushes higher again. These repeated engineered lows tell us something important. The market is very likely to revisit that level again. Now, as traders, our first instinct is usually this. If the market closes above this previous high, that's a clean structure break. I can safely look for buys and continue the trend. And yes, under standard structure rules, that makes perfect sense. But in this situation, what we're actually dealing with is something deeper. Liquidity. Liquidity simply refers to where orders are sitting in the market. Stop losses, buy stops, sell stops, essentially, where the money is. Those zones are where we see the strongest reactions because that's where large clusters of orders get triggered. Think of it this way. Above a clean high, many sellers have their stop losses, and breakout traders have pending buy stops. Meaning there's a huge pool of buy-side liquidity sitting right there. So if you wanted to sell from that level, you'd easily find buyers to fill your sell orders. This is why the market loves reacting to liquidity. It's where all the fuel is. Liquidity shows up in equal highs, equal lows, trend lines, and tight consolidation blocks where price is bouncing between the same levels. All of these create what we call range liquidity, and understanding that is key, because the market often takes one side of the range before driving aggressively to the opposite side. In this example, on both sides, we're sitting on range liquidity. Here's the first big point. The market is naturally drawn into these pools of liquidity, and once it taps them, that's usually where bigger reversals happen. But here's the catch, just knowing the theory isn't enough. The real challenge is figuring out where the important liquidity actually is. And for that, you must understand context. Whenever I analyze a market, I always zoom out and think about the broader narrative. Where is the market most likely to reverse? Where is the next burst of momentum most likely to come from? Which direction does the bigger picture naturally want to move toward? Once you understand this narrative, identifying true liquidity grabs becomes far easier, and you can correctly distinguish between a genuine shift in market structure and a simple sweep designed to fuel the next move. So naturally, our expectation is that after any corrective pullback, price should continue moving lower. Now, to validate that bearish narrative, we start studying how price reacts to bearish PDAs, specifically, bearish order flow and supply zones. And once price reaches that OB, what do we see? A clear consolidation forms, and even better, we get engineered equal highs sitting right above the zone. This is important because engineered highs equal liquidity. It shows the market is building up buy-side liquidity right above the consolidation, giving smart money a perfect reason to sweep that level before sending the market lower again. On the other hand, price has reached an order block that serves as an important demand zone for us. A supply zone basically tells us, hey, a lot of selling happened here before. Meaning traders saw this area as an expensive price, unloaded their positions, and pushed the market lower. So when price returns to that zone, it's reasonable to expect sellers to step back in and react from that same premium area again, especially in a downtrend. So inside this overall range, what I'd normally want to see is a supply zone with imbalance leading into it. Price, after reaching the order block, forms a range and builds liquidity, showing that it still doesn't have enough fuel to continue the move. But here's the important part. If we look inside this little boxed-in range, there's no imbalance. So what does that tell us? It tells us there's no strong, significant supply zone inside this range. And if I'm looking to sell in a downtrend, and I don't have a solid supply zone to sell from, well, that instantly makes me think, the market probably isn't going to reverse from this level. Because there's no major supply here, no premium area, no real selling strength, nothing for the market to lean on to create a strong move downward. So by creating equal highs, it's trying to generate the liquidity it needs. So based on everything we've just looked at, here's what I'd be thinking. We've got a couple of clues that suggest price might actually want to go higher, not reverse from where it is right now. Why? Because we still have imbalance sitting above a FVG and we still have that significant supply zone higher up. On the other hand, the equal highs, along with the liquidity resting above them, and a breaker block. So if price breaks above this current high, I wouldn't look at that as a major bullish structure shift. I wouldn't expect the market to start forming a higher low and then continue into new lows. Instead, I'd look at it as the market simply sweeping the high. Remember, the area we're currently sitting in has no meaningful supply. There's no real premium price here, no imbalance into it, no reason for big sellers to step in. So it makes way more sense for price to push higher, sweep liquidity, and then tap into that next real supply zone. That's where we can expect a proper reaction. So even though price pushing through this high technically looks like a bullish structure break, that doesn't automatically mean we're shifting into an uptrend. In this context, that break is more likely just a liquidity sweep, not the start of a reversal. This is where a lot of traders get confused. They think, if we break the high, that means trend reversal, right? But when you understand context, equal highs, imbalance, supply zones, where sellers actually care, this kind of break is just a sweep, not a real shift. Now let's zoom out and look at the bigger picture context. We've already talked about two key elements here. 1. There's equal highs zone above, and 2. There's clear imbalance and breaker block leading into it. 3. There's equal lows zone below. These three things together give me a lot of confidence to take a trade against what many traders might mistake as a bullish structure shift. Think of imbalance and liquidity like a magnet. When price leaves an area too quickly and creates that gap, it almost always wants to come back and fill it. In this situation, what looks like a structure shift is actually just a liquidity sweep. Price sweeps the high, trades through the imbalance, taps into that major supply zone, collects a ton of sell orders, and that's what drives the market back downward. So instead of viewing this BOS, break of structure, as the start of a reversal, we classify it as a liquidity grab designed to sweep the high, fill imbalance, retest supply, and then continue the overall downtrend. So the big question is, when would I actually change my bias? Well, if price breaks through that supply zone, if we rally up like this and completely violate it, that's the moment I shift the narrative. At that point, I wouldn't look at the move as a sweep anymore. I'd classify it as a clean break of structure, because breaking through supply tells us one key thing. Sellers aren't strong enough to hold the level. And when supply fails, the next logical expectation is a pullback and then a continuation higher. So with hindsight, once we clearly see supply break, we can take a calculated, confident trade in the direction of the new move. But right now, while that supply zone is still intact, and while the imbalance above it is still open, we treat this whole move as more likely a sweep, not a real bullish shift. So that's our first setup. Using supply and demand, along with imbalance, to filter out fake structure shifts and figure out when a break is actually still valid for continuation. And remember how we formed this bias in the first place. There's no meaningful selling zone in the current area. But there is a significant selling zone higher up. So if we want to continue this overall bearish move, price needs to return to that zone of real interest before pushing down again. We place the stop above that supply, and for simplicity, we target the range liquidity low because we already swept liquidity at the top. So now we're anticipating a sweep of liquidity at the bottom. This creates the perfect scenario to take advantage of the short-term move down. And as you can see, that's exactly what played out. Price swept the top, shifted structure, retested supply, and then dropped right into the liquidity below, giving a clean selling opportunity. What we're doing is simple. We build the macro narrative, we identify the significant zones, and then we use range liquidity to take smaller, high-probability trades while we wait for the big move to play out. We don't have to gamble. We wait for the standard confirmation to show up. Once the market confirms the direction we want, we take the pullback entry, and at that point, the probability of the trade working in our favor is way higher. Anyway, I hope you enjoyed the video and got some real value out of it. Thanks for watching.